welcome to Finforall by Jupiter. My name is Dipansha Dhingra and today we're gonna learn how to select a mutual fund. We keep hearing about mutual funds, but do you know why they are called mutual funds? A mutual fund is an investment product that pools money from all its shareholders to invest in securities like stocks, bonds, money market instruments and other assets to meet the capital gains goals for its investors. That being said, there are ups and downs to any market and you can't expect a straight line to profits from every mutual fund. You need to carefully select what you invest in, and as hard as it may sound, it really isn't that bad. A little research goes a long way. Today we'll talk about 5 main things you should consider when selecting a mutual fund. If you're yet to start your investment journey, then you must be one of the smart ones to come to this video. So without much ado, let's get started. First, set your goals. While the purpose of all investment is profit, depending on your goals, the extent of profit can vary. And your financial goal is the first thing to keep in mind when investing. Do you want a fund for a quick profit? Is it for a holiday? Or to make the deposit for a house? You could also be looking at a fund for retirement, or your wedding, or your children's wedding maybe. Whatever the answer may be, it is crucial to start by asking this question. Being clear about the goal also gives you a time frame for your investment. For short-term appreciation, you could choose something like a liquid fund. But for long-term goals, you may want to get into stable equity fund, which may even come with a lock-in period. Second, know your risk appetite. As much as we would like to go by "Dar ke aage jeet hai," the motto becomes a tad bit complicated when money is involved. It is important to know how much you are willing to lose. This is not to say that you will essentially suffer losses, but your risk appetite helps govern what kind of funds you will invest in. Risk and returns are directly proportional, so the higher you would want to go, the more you must be willing to risk. Again, there are many financial instruments that are relatively stable, such as gold or debt funds, but their appreciation may not match that of an equity fund, which is quite volatile and affected by market fluctuations. Third, check your fund's historic performance. Needless to say, charts don't lie. If a fund hasn't been beating the benchmark for the past 3, 5 or 7 years, then it may not be a good investment. Check the historic performance of any fund over multiple market cycles. While you are at it, you may also want to look up your fund manager or asset management company. A proven track record, even if the current cycle is not going extremely well, is a sign that your investment lies with experienced hands. Fourth, check the expense ratio. Expense ratio is basically a fee charged for all operating costs related to a fund. This includes stuff like management fees, sales and marketing expenses, custodian fees, etc. We have discussed expense ratio in depth in another video. The lower the expense ratio, the greater your returns would be. Also, expense ratio is accounted for when returns are displayed for funds, so you don't have to do any additional math to figure out your returns. Within the expense ratio comes another important component called the exit load. This is the fee you pay when you try to redeem your investment earlier than the lock-in period. Again, the lower the exit load, the greater your returns would be. Both expense ratio and exit load are rather relative, and these values being low for a fund doesn't automatically make the fund a better option. Some of the top performing funds might still have slightly higher expense ratios, but given their output, they may still give you higher returns. Fifth, unsurprisingly, are taxes. When looking for a mutual fund, you must be aware of the taxation and any benefits you might have. For example, if your fund pays dividends, a dividend distribution tax or DDT of 10% is deducted at source. In equity funds, you pay the short-term capital gain tax of 15% for a holding period of less than 12 months. You pay the long-term capital gains tax of 10% for a holding period of 12 months or more. But gains up to 1 lakh rupees are tax exempted. There are other things that one can look for as well, such as whether a fund is actively managed or passively managed. In an actively managed fund, you pay a higher expense ratio owing to the fact that it would need money managers doing all sorts of crazy statistical calculations to get you maximum returns. In passively managed funds like index funds, which just mimic the performance of an index fund without much dependency on a manager, the expense ratio would be far lower, but so will the returns. The good part is that all this information is readily available. The bad part is, of course, going through it. While it might seem better to just take advice from the adultier adults around you, it is very important that your financial decisions are based on your needs and wants. Thank you for staying tuned. For more on finance and everything beyond, follow Finforall by Jupiter on YouTube, Instagram and LinkedIn. Don't forget to leave a like and share your views in the comments below.